Hello and welcome to this programme from Baillie Gifford, the latest in a series where we talk to the managers of the group's different investment trusts. My name is Richard Lander of Citywire, and I'll be talking today to Douglas Brodie, who is the manager of the Edinburgh Worldwide Investment Trust. The trust invests in smaller entrepreneurial companies, exciting cutting-edge businesses where Douglas and his team see long-term growth potential. Welcome, Douglas. Thank you for joining us today. I noted that about a year ago, the chairman of your trust described it as being in the eye of the storm. Now, storms normally pass on reasonably quickly, but it seems this storm has rather stuck around for quite a while, hasn't it?
Yeah, sure. Afternoon, Richard, and afternoon, everyone. Yeah, I'd say we've always been in a sort of continuation of that storm that I was referring to, maybe with more recently a sort of sense that some of the storm clouds are beginning to clear, but maybe just to sort of recapture what I mean by that storm, the tail effects of a pandemic, an atypical inflation spike, very rapid move in interest rates, geopolitical tension, conflicts, etc. These have all been a really kind of potent mix, and I think what the effect of these on our companies is actually pretty modest. They do have a significant impact on that broader investment environment. Most obviously, I think through discount rates, we've all felt that and seen that. That flows through to valuations, etc. But maybe more perniciously on sort of investment psyche, that willingness to tolerate risks, it really pulls in investor time horizons. And I almost can't think of a period in history where investors have been challenged with so much over a sort of 2 to 3 year period. So yeah, a pretty potent combination. It works against growth investors like ourselves. And I think that, as you say, it's more acute in a portfolio like EWIT, which naturally skews to these immature companies. Part of that is mechanical. These businesses are innovative, they're entrepreneurial, they have a cash flow profile that skews to outer years. Some will be investing up front to deliver those cash flows, but maybe some of it I think is actually more rooted in sentiment. For growth investing, I think the skill set here is really around postulating what change might be achievable. It's not just about extrapolating the here and now, and it's about understanding the quantum of cash flows that a company may build, not sort of second guessing the discount rate, and kind of piecing all the pieces of the jigsaw together. What might be possible? Who are the entrepreneurs that can do that? What might be the prizes to those that actually manage to get there? And frankly, yeah, it's business building, and the time horizon you need to do that, I would say, is minimum 10 years. We are used to doing that in a stock market that has a shorter time horizon than ourselves, quite clearly. I guess we're less used to doing it in a stock market which is quite scarred and risk averse and doesn't actually like to project out much more than sort of 18, 24 months.
Right.
Yeah, so these things matter to us. It's clearly painful for us to go through. We recognize the pain that shareholders have taken. It's not easy, and we've lived that and we've felt that. But I think really the opportunity from here for growth investing is frankly as attractive as it's been in a decade, if not more. I've reflected that actually through increasing my personal stake in EWIT, is to sort of amplify that fact.
Right. I mean, you've got all the factors in there. You've got tech-oriented enterprises. They're smaller companies. Several of them are unquoted. I mean, of all those levers, which one do you think hurt you most over the past year or two?
Genuinely difficult to disentangle, and I think trying to portion blame across those sort of things. When I think about the performance of EWIT, it's probably a little bit of all those things that you touch on there. As you come down that market cap spectrum, just the number of companies blooms out. The inefficiencies rise, the liquidity distortions become more evident. I've been a small cap investor now for over 15 years, and there's long been that pattern that sort of generalist investors sell out of smaller companies at times of stress. They almost treat them as a proxy for risk, and I think that's very much occurred in this sell-off. And it's blunt, but that's how people treat this, and I think that's led to this sort of valuation discount on smaller companies versus larger companies that a lot of commentators have actually picked up on. Your point around technology, I think, is actually interesting, like really interesting, because if you look at the NASDAQ, you probably wouldn't say there's been a challenge to technology. There's been a handful of very large, almost digital utility companies that have dominated the returns profile in technology. And I'm not trying to put down those companies, but it's quite narrow and it's quite linked to one particular theme, which is the theme du jour, which is the artificial intelligence theme. You touched upon the unlisted, so maybe just to give a little bit of context around that. In the Edinburgh Worldwide Investment Trust, we have 14 private holdings. Comes in weight that matters to just under 25% of the fund, dominated by two large positions in two very exciting businesses. SpaceX and PsiQuantum make up about half of our unlisted weighting. Other themes that were reflected in there, we have low-cost radar systems, clever heat management systems, next-generation particle accelerators. So when we use that unlisted element, it's really to take us into areas of opportunity that, frankly, we can't readily access in listed markets. And we often get asked about the valuation process for these private companies. I think we've done a lot to educate the market around that. That's kind of probably beyond some of the discussion time that we've got here. But we do have a very active process for valuing these businesses. So yes, intuitively, for me, it shouldn't feel like that the unlisted elements are a drag on the performance or a drag on the valuation. But knowing how markets are operating at the moment, they probably are. There's a clear pattern if you look across our investment trusts. The ones with the biggest discounts are the ones with the private companies.
Right. I mean, you have at the heart of this a sort of dysfunction between the sentiment and the mood of the market and your long-term vision as investors. Sure. Now, there's the famous cliche that no one rings a bell at the bottom of the market or the top of the market. But is there any signs that you see that sentiment towards the type of investments that you manage in this trust beginning to change out there?
Yeah, it's always a challenge for us when we're asked to sort of call turns in sentiment, because it's difficult and it's not generally a skill that we seek to hone. It tends to naturally pull you into sort of shorter term market commentaries. But I think, as I suggested earlier on, some of the storm clouds are beginning to lift. In terms of how we run the fund, look, we're controlling what we can control. And that really is the aggregate quality of the portfolio, allocating capital to businesses that really excite us, where we think the prospects for really outstanding sales growth and profit growth really exists. We are not naive to the environment, and we observe it around us. And for me, I guess the inflationary debate is beginning to run its course. Rate cycle that sort of feels in its twilight stages. Arguably, you've now got a rate cycle where bits of that might be actually quite inflationary. If you're paying rent and you're funding car insurance and home insurance, the current environment is actually quite unhelpful for you. But we don't know exactly when this thing turns, but I think that the monetary medicine has been taken. Yeah? The patient is beginning to respond. And for me, it doesn't feel like that will be a chronic course of therapy. So we're confident that over time, don't know exactly when, but it will return to a more fundamentals-led market. We do often get asked about that interest rate element, and we did a lot of digging around that and sort of historical precedents for that. So if you go back in time to look at the last, I think it's 6 big interest rate hikes in the US, going back to, I think, 1983, the average increase in the Russell 2000, the mid-cap index in the US, was around 33% in the 3 years following the initial rate rise. And for at least, I think it was about 3 of those occurrences, it was almost 50%. So this sort of mantra of the rate environment means terrible upcoming returns for smaller companies doesn't feel valid. Look, I know history doesn't always repeat, but it probably rhymes. But if we look at the portfolio, that's where we take our excitement from. So we've got a cohort of companies in there we think delivering really well. We have a cohort of companies that we think over the next 2 to 3 years will really prove their clout. And that's generally the ones that will be transitioning from sort of pre-profitability to highly profitable companies. Now, we have many companies that have used the current period to get themselves leaner, to get themselves fitter. In aggregate, we actually carry, I think, really interesting exposure to big areas of change, really resilient businesses that we think will be equipped to actually prove that and deliver that. So yeah, ultimately, the companies will hopefully deliver on the promise that we see. And we know some of them won't. We've actually had that a little bit the last couple of years. A couple of our companies have disappointed in terms of operating performance, but in a portfolio of sort of 80, 90 ideas, you will always have that.
Great. We'll come back to the companies in there in a minute and how you've been changing the portfolio. You've got this lovely phrase that you use that you invest in companies which you see as early enthusiasts of rewiring their industries, which is just a great metaphor. So how do you go out and find those companies? And then once you've found them, you've made an investment, how do you know which ones to stick with, even if their share price performance is disappointing?
Yeah, sure. We've got the privilege of trying to spot these companies in their most dynamic, exciting phases of their growth. They will be in the foothills, frankly, of their commercial opportunity. They will be trying to find their way. They will be trying to find their product market fit. They will often be with their offering. They will be internationalizing. They will just be active on so many different fronts. And it's unlikely to think that the progress of these businesses will not be linear. That's sometimes the mistake people make when they come down the market cap scale. So maybe for me, the challenge has always been about one of finding companies where they are building out long-term relevance and long-term durable edge, and you retain the ownership of those businesses as they expand and they capitalize on the potential. That's the rewiring of the industry's element that we talk about. Now, it may be proxied for how fast they're growing at a given point in time, but that frankly tends to be a little bit of a poor proxy. So it's really long-term delivery against that long-term opportunity and objectives. That, I think, is what we've shown we can do with very successful investments that we've made in the likes of Tesla and Dexcom. But for me, maybe if you flip to the current portfolio, one example I think that really captures that evolution of these businesses and that refining that they go through very neatly is a UK company called Oxford Nanopore, now one of our biggest holdings in the trust, actually. We've owned it for about 8 years. It was the first private company that we invested in for Edinburgh Worldwide. And we took that initial position because we were really deeply intrigued about what their technology offered. There was real glimpses around this could be transformational for DNA sequencing. And through, look, it wasn't perfect. They had to refine it. There were hurdles they had to get through. There was a clear path for this business to increase its relevance. And in the early days, like, these companies are raw. They will have a degree of immaturity about them that they have to navigate, maybe even sort of commercial naivety. And I don't kind of mean that in a bad way. It's almost inescapable that the young companies have that. So you have to be tolerant around that. And frankly, in the case of Nanopore, it's been great to see them blossom, really play for this. In recent years, it's been the fastest growing sequencing platform, the fastest growing sort of base of consumables used on sequencing platforms. And that's really the proxy for how scientists are actually out there and engaging with this. So yeah, to see that promise translate into relevance, that's a very live example of it, and one that's still I think got huge potential to run. Their advantages really extend into the applied and clinical sequencing. And again, I've got that sort of luxury of looking across lots of different endeavors in healthcare on a global basis, and I think I'd struggle to point to a business that it's really got that potential to translate genomics into real world impact in a way that Nanopore has. So yeah, maybe just to round out, you look on the frontiers for where change is happening. You find the businesses and the people that are doing that, and you stick with the ones that are delivering and building towards that long-term relevance, where their edge is hardening, where their commercial presence is building, and often where the paths to evolve are building and scaling out.
Yeah, I mean, I suppose in a company like that, you're taking the finest brains in their field, and then it's up to you and other investors to make sure that they've got the commercial nous, or import the commercial nous, to make that a profitable business at some point.
Yeah, no, definitely, yeah, I agree.
Yeah. Another example, a bit closer to home for the rest of us, is Ocado. Now, an amazing firm that's not so much changed the way we shop as the way that has changed the way that supermarkets can organize themselves to deliver online, but it's taken and continues to take an awful lot of capital expenditure to get there. And do you think a company like Ocado, with all that continuous investments in robotics and warehouses, can ever deliver the returns that reward you as a shareholder?
In short, yes, but maybe I almost view Ocado as a sort of microcosm for what's gone on in equity markets over the past couple of years. So Ocado, the business, has performed pretty well during that time. Like it's scaling the volumes with its existing partners. They all go at different paces. They all learn how to use this technology. Some may go faster, some may go slower, but push comes to shove, we're pretty happy with that. We've had clarity on the litigation with AutoStore that came down in Ocado's favour. You had Lotte about a year ago, a big South Korean retailer, sign up for their platform. And we always want our businesses to be aspiring to do lots, and we've got high hopes for Ocado. But I think that sort of near-term progress with Ocado, you'd say it's pretty solid. That its relevance is building, to use that sort of terminology that I was talking about earlier on. But if you were to pull up the Ocado share price, it feels a very different story. You'd be kind of thinking this is probably the most cyclical, most volatile, most financially stressed business out there. So just in the course of year to date, the share price has halved, then tripled, and then halved again. And this is a grocery retailer with a technology twist. This is not uber cyclical stuff. So there is this sort of disconnect that we see across many of our businesses between the performance of the fundamentals and how stock markets sort of ebb and flow around them. And I think it's most obvious where the critical events for the companies, if they sit sort of 18, 24 months out, they struggle to get sufficient airtime in the current stock market. So when you think about Ocado, the big points of relevance here will be its next generation kit. How does that land and resonate with its existing customer base? Can they build potentially a sizable non-grocery business? Can they go much deeper with existing partners? Can they go into countries and continents where they are not yet currently present? And to your point around returns, look, we're very comfortable with the returns that Ocado earns. There is a CapEx spend, part of that they ultimately fund with their partner, and part of that is almost dictated by the pace at which they grow. And I think there are interesting ways in which they can sort of evolve that over time. And maybe what you've seen actually with Ocado, it's a battle in how people value businesses, different valuation approaches. How much do you anchor Ocado in the here and now and say, well, it's everything that I can see and everything that I understand, and that's how I'll treat it? And how much do you factor in Ocado growing, evolving, executing in the way that we know it has done in the past, and kind of postulating where it might get to? And that's kind of classic growth versus value arguments, anchoring around a sort of different time horizon of approach. And for me, that gets to the crux of where we are with this, frankly, this interest rate debate, because the mechanical side of it, the valuation reset, that happened. That's frankly a story of the past. But maybe what you've entered into now is a territory where investors are faced with a risk-free rate, 5%, 6%, wherever you go in the world and whatever you take. But it's not maybe irrational for them to go, well, the future, I'll just kind of wait and see. I'll take the interest payments between now and then. And that's fine to some extent, but you tend to find fundamentals move quite quickly, and share prices anticipate fundamentals, and rate environments change. So yeah, I think bits of that kind of weirdness that we've had will self-correct.
Right. So fascinating. You're sticking with Ocado, which is great. But you have been busy last year and this year reshaping the portfolio. You've had companies which have exited, and you've taken new positions. So perhaps just talk us through one or two of those, and maybe describe, did you have any common theme or thoughts as to how you've altered the holdings and changed the outlook of the portfolio?
I can talk about that. Yeah, we are a low turnover fund, so typically sort of turnover in the order of 10%. But if you combine that with the fairly big dispersion in returns that we've seen for some of our holdings, yeah, the shape of the portfolio moves. So I would describe the active side of it as sort of disciplined allocation of capital to areas that we think have that growing relevance, where we sense that the stock market is getting blinded to the near term and not thinking longer term about where these companies might get to. Frankly, that has actually skewed us a bit more towards the companies that we think will become profitable over the next 2 to 3 years. That's really where we've seen the opportunity. And when we funded that, frankly, through a reduction in the number of holdings, we've moved on from some businesses where we sensed there was degrees of either balance sheet strength, balance sheet weakness, or growth weakness. And companies like Lending Tree and Wayfair were sort of removed from the portfolio on those grounds. We've actually had a number of portfolio companies taken over. I think we're at 3 in the last 12 months, which might be interesting in and of itself. We've sold out of a number of holdings in what we would call our tail positions, where frankly, ideas that haven't worked and have disappointed. And while the performance in aggregate of the portfolio from a sort of NAV perspective has been disappointing, we've had some, standout stocks that do well, and we've been value cognizant in those cases, and in a number of businesses like Axon, Exact Sciences, Genmab, we've actually felt that the market has been catching up a little bit with our view. So we've trimmed them. We're adding to these earlier stage companies where we think the relevance is building. I've touched on Nanopore. We've added to a business called Schrödinger, which is using computational drug design to improve that drug development process. We've added to companies like Sprout Social, growing relevance in terms of social media and how companies engage with that. We've added to LiveRamp, a real sort of technology provider into media tech and helping companies understand their users and track their users. And we've added to Appian. So we have a host of these, I'd say, sort of mid to upper tier businesses where we've really boosted them up the fund. The idea generation has continued. If I pick out a couple of ideas there, we bought a new position in a business called Transmedics. Very interesting technology for perfusing organs and keeping organs alive outside of the body, and potentially revolutionizing how people approach that transplantation market, which historically has had some huge bottlenecks. Businesses like MP Materials, which we think is really in that sort of sweet spot of rare earth magnets and sort of mining and refining of those, and really sort of piggybacking on that huge electrification that we see across lots and lots of industries. So yeah, we've been active on lots of fronts.
Right. Okay. If we'd had this discussion 2 or 3 years ago, the next question would have been about ESG and sustainability, but it's now 2023, so we're going to talk about artificial intelligence, which has sort of moved ESG off the center stage. How important do you think it will be, not only for the world as a whole, for everyone watching this broadcast, but for how you shape your portfolio?
Yeah, look, it's, as you sort of hint, it's clearly the topic that's captured the mind share following that sort of big reveal of ChatGPT and these local language models, which frankly from the outset have proved to be very, very adept. AI as a topic has been around for a reasonable bit of time. We had exposure to that from Tesla and autonomous driving. The reason why in Oxford Nanopore has crept up the accuracy and increased its relevance, it's the AI-based decoding of the signal. So lots of companies have been using this, but I think that the change here has been these local language models, generative AI trained on very, very large data sets. And for me, that offers a whole world of efficiency savings for those that embrace those technologies, from generating novel content very cheaply and quickly, to really engaging human-like interfaces, and maybe just being able to take an awful lot of that grunt work away from a sort of employee base. It would be that software coding, interpreting complex documents, deep efficiency tools that will transform many applications in work. I've been playing around with an internal thing here that we have recently, and I can take voice-based notes that I've recorded myself post a meeting, and quite quickly and easily use AI to translate that into a kind of fully fledged meeting note. It's really quite exceptional what this stuff can do. I think it's important to note that these tools are widely available. So almost think of them as foundational tools where individuals and businesses kind of have ready access to it. So it offers this huge potential for those that are willing to work with it. We are constantly on our companies emphasizing almost like the table stakes nature of this. So if you are a company with a kind of scaled out customer service function, you need to be on top of this. If you want any sort of degree of personalization about your website and your digital interfaces, you need to be all over this. If you do any coding, you need to understand this. Maybe when it flips to sort of like the portfolio, we're intrigued by companies where these changes in AI might actually have direct relevance to the product offerings of these companies. We've got holding in a business called Upwork, which is a freelance marketplace. A lot of the AI talent hangs around on that marketplace. Can you also use AI to increase the productivity of freelancers? We have a holding in CyberArk, which is a sort of cybersecurity business, and the nature of the threat, frankly, in cybersecurity has changed quite radically when we're now almost like computers can do a pretty good representation of a human. You need to ensure password and encryption and all your security is complicit with that. We have a holding in Axon, the maker of taser and police body cameras. They will be using this to sort of transcribe and extract information from video transcripts, etc. So there's a host of companies where it touches, but yeah, the efficiency and particular use cases where this could be huge.
We can't wait. I'm going to move on to Q&A from the audience in a second. So just one last question from me and that's really, and maybe this overlaps with the answer you've just given, where do you see the most interesting opportunities coming from as we move forward?
Okay, I guess we sort of touched on aspects of AI, so I won't sort of duplicate that. And we've had a long sort of outstanding interest in the commercial relevance of space. We've got holdings in companies like Astranis, which is very low-cost geostationary satellites. Our biggest holding in the portfolio is SpaceX, which I guess we all know is the company that does the cool sort of videos with the rockets landing. But maybe what's less familiar is just how dominant they have become in that area of commercial rocket launches, really driving down the costs and hollowing out that. And they've used that presence to kind of vertically integrate with their own satellite business, Starlink, which is now, I think, the largest constellation of these low Earth orbit satellites out there. And the way, frankly, that they've scaled that business, I think Elon Musk was on record just a couple of days ago saying that the Starlink, the satellite entity within SpaceX, is cash flow positive. That's after just 4 years of being launched, and I think a pretty valid claim to becoming the first globally relevant utility company, and really exceptional routes by which they could evolve that. We have a big theme in the portfolio that kind of anchors back to DNA, all the way from companies that make DNA as a research tool, so Twist Biosciences, companies that interrogate DNA. I've mentioned Nanopore. We've got holdings in companies like Billion to One doing prenatal testing, Exact Sciences doing cancer screening. We have companies like Alnylam targeting DNA through sort of clever DNA-like drugs. So just that ubiquitous nature of DNA across so many processes, I think the tools and the reagents people are coming up with now, really transform that. And maybe one just to sort of finish on, I mentioned PsiQuantum earlier on as one of our largest unlisted companies. We think that aspect of quantum computing is something that's really going to bubble through and be on the mainstream radar over the next 5 years or so. The sophistication of models, computational models that could be run if people really crack quantum computing, and that's moving away from sort of chips that work on transistors and binaries and zeros and ones, and chips that can handle basically multiple states, and that's the crux of why they can solve bigger problems, and effectively a technology that frankly should really dovetail very neatly with all the advances in AI. And PsiQuantum have a very interesting approach in this area. They are using optics, photonics, lasers, beam splitters, etc., to use proven technologies to build quantum systems, which is radically different to others who start almost like as a theoretical physics project, try and solve that, and then think, crikey, how do we actually translate that into a commercial product?
Wow. So there's a lot out there as a way of summarizing what you've just been saying. I'm going to move on to questions from the audience. And this one relates to AI and what we were discussing, but I guess the same for all your companies you invest in. Can small companies in the AI field hold their own when you've got the tech giants are investing so much in the area, in these areas? Do you ever fear that they just might get trampled underfoot by the weight of these companies?
I think what you're seeing currently is for AI to become established, it needs the infrastructure in place. And these AI systems are power hungry, they are processor hungry, they are data hungry. That requires chips, that requires servers, it requires an awful lot of cloud infrastructure. And frankly, look, there's bits of that is the sort of the big boys game. That's where the big incumbents, the cloud companies, the NVIDIAs play. But that's really providing the infrastructure which these AI models will run on. And as we've seen, as digital technologies and computer-based technologies and operating systems came through over the last sort of 10, 20 years. The real bit where the commercial opportunity sits is frankly the applications that are built to run on this. And I would argue that smaller companies being more nimble, being able to grab stuff and work with it without the sort of the baggage of bureaucracy, are very, very well equipped to do that. Maybe for me, the bigger debate here is around, is AI and how it works. Is that something that works for kind of very new startup companies, or is it something that instinctively skews to pre-existing companies of all sizes, small, medium, large, whatever? But is that the divide in which we think about this? Because you think about these models, they need data to train them. They need users to experiment with them. To do that effectively, you quite often need a brand, you need data, you need presence. That's something that intuitively feels like it works to existing businesses' advantages. So I almost view it as it's a disruptor of processes and workflows more than it is a disruptor of incumbents and new starts doing that, if you see what I mean.
No, yeah, it's coming back to the rewiring thing, I guess, isn't it? Okay. You talked about SpaceX and Starlink there. So a viewer's comment, please could you give us an update on the SpaceX valuation today, and how does it compare with the cost of your investment there?
I'm given NDAs and stuff, I'll struggle to sort of give detailed insights on the financial performance of the business, which kind of you need to do to talk in detail about the valuation. Very, very rough numbers here. And if you go back in the EWIT accounts, we could probably track this over time. I think we invested when it was about a $20 billion business, and I think the press reports on it now are comfortably north of $100 billion.
So that's going well. And you get to talk.
Yeah, we do often, as I say, get asked about the unlisteds and the weighting of it. And we're up at sort of 25%, which is the max level at which we're allowed to make new investments. But as I reflect upon that, it's been a real success story to have done that. It's been driven by very good returns in two companies that we own, PsiQuantum and SpaceX, combined with that sort of de-rating on the listed equity side that we've all felt and experienced.
Excellent. Something went off in my ear there. Another question is, how do you work across the piece with the other managers of the growth-oriented Baillie Gifford Trust, particularly Scottish Mortgage? There's obviously some overlap there, but how do you combine your thinking to make the best of it for everybody?
Yeah, I've worked at Baillie Gifford all my life. It's a genuinely collaborative investment floor. I came from a sort of science researchy background, so I was used to a collaborative environment. I did slightly fear coming into finance it would be everyone out for themselves and no one sharing ideas, and it's not the case. That there's a common currency on the investment floor, which is around intrigue and insight and desire to understand how the world will change. Different teams go about that in different ways. They'll have different questions they ask of companies, but that common currency that we all engage with is I think key to it. So yeah, I think we overlap with several companies, with many of the other investment trusts. I'm a scout for the Global Alpha team, from which the Monks Investment Trust is managed. So it's always, it feels very intuitive to us, but I know sometimes the outside world struggles to get that we do share these things. We talk about them, and ideas are good ideas, and they should be owned in scale by as many people that can own them.
Another question here, generally about your, I suppose, what makes your DNA as an investment manager. How do you prevent yourself from falling into the trap of buying great stories, but companies that aren't necessarily great investments?
Yeah, there are, and to cut to the chase, we have had a few examples of that over the past sort of 4 to 5 years. I mean, it's, you will, if you do what we do, you will always have the risk of investing in companies that fail to deliver. It would be unrealistic to think that would not be the case. And maybe as we've reflected upon that last sort of 3 to 4 years and all the weirdness that came with it, almost that extreme outperformance in the early stages of the pandemic, and this sort of weird underperformance that we've had a bit since then. we should have moved on from some businesses that we didn't do. And with perfect hindsight, that's always easy to say. Maybe there were a few companies that we owned where I would say their ambition ran ahead of their ability to execute. That's quite hard to predict up front. You want to believe in these companies, you want to believe in people delivering for you, and you assess their capabilities around being able to do that. But particularly, I think towards the tail end of that last sort of run up in equity markets, there were management teams that overpromised and then ultimately underdelivered. Yeah.
Right. Relevant to that, someone has asked, how's your attitude, your investment approach? How different is it from, say, 4 years ago before the pandemic was upon us?
No, I think that you don't come through a period like we've been through and not reflect upon what could you have done differently. Is our approach relevant? And look, and I think a lot of teams, frankly, at Baillie Gifford have done this. Look, we kick the tires on our approach. We get challenged by the board on our approach. So we think what we do and what we set out to achieve has real merit. Trying to do that, frankly, in listed markets is difficult. But you learn to have strength of character in your approach, how you handle difficult periods. You have a finer tuning for which management teams you really want to back, which ones are you maybe want to see more evidence. So you're constantly learning upon multiple different fronts. You always do that as an investor, but the core crux of what we do, which is trying to find businesses that we think will have ultimately huge relevance, persists. That always endures. It's not like it's almost that sort of silent hand of human progress that is constantly out there, and we try and tap into that. That's where we think we earn our crust, and doing that in stock markets is difficult.
Right. A couple more questions, and then we're going to wrap up, I'm afraid. One is, lots of people have described this as the most difficult time they've known as an investor. Would you agree, or would you think it's more exciting than that?
It's what we do is fundamentally really exciting. Like I still say this, and despite the bruising period that I've been through, I still think I've got the best job in Baillie Gifford, because I get out there and we try and find these businesses, the team that I work with, and it is the companies that we think will be on the frontiers of driving change, and that's exciting, and it's a real privilege to do that. Doing that in listed markets, it will throw periods at you where you feel silly. You are being made to feel silly by a market that operates at a different pace, a different time horizon, will be concerned about things that intuitively you don't think are super relevant. It's bruising, it's humbling to go through that, but it's in modern investing, it's to some extent inevitable that you'll have periods like that. It's not fun, but the fun bit is getting out there and meeting the companies. That's what you feed off, and that's where your enthusiasm resides. Right.
Final question that's come in is, what book have you read over the past year that you might recommend to the audience, as not necessarily on investing, but in to what's going on in the world around us?
Yeah, I thought the Power Law and the History of VC was very interesting. I'm still to read the Elon Musk, Walter Isaac's biography. I've been quite snowed under with work at the moment, so there's a few books. Honestly, for me, I'm more a reader of scientific publications, science journals. That's where I personally take my sort of creative inputs, and where I sort of sounds a bit nerdy saying this, but I'd quite happily read some scientific papers to relax. God, I actually can't believe I said that in a public forum, but yeah, there you go.
Brilliant. Thank you so much. That is all we've got time for, I'm afraid. So thank you so much, Douglas, for joining us, and your time and your insights. And thank you all at home for watching and for your questions. We do have more sessions like this coming up, so please do keep an eye out for those if you found today useful. Just to wrap up again, to Douglas and to all of you, thank you so much, and we hope you found it very useful.